you say that Amazon represents the best risk reward in your coverage universe. I wonder about that because from some others, we've heard some doubts recently on what really the driver is there. There's been some retail slowdown in growth. Is it AWS that's still being underestimated, you think?
Yeah, I mean, I think as far as things go, AWS is the one that's probably still being the most underestimated. But when you think about sort of the biggest drivers in technology, Amazon's got leverage to three of them. The shift of retail spending dollars online, the shift of workloads into the cloud, which obviously they leverage with AWS, and then the growth in online advertising, and particularly the shift of online advertising dollars from consumer packaged goods companies that we're still relatively early stage in. And so those three things combined, along with the where the stock's trading right now, is what leads us to think that that's the best risk reward in internet still. They'll go through growth cycles where things accelerate and decelerate, but with a longer-term view, that risk reward's really as good as it gets.
And so, Heath, if we really do see these big anticipated IPOs this year from the likes of Uber, Lyft, Airbnb, et cetera, where's that money going to come from? And is it going to have an impact on the stocks that you currently cover? Are investors either going to turn more attention to tech again writ large and it lifts all boats, or are investors going to take some money out of some of the tech companies where they've had it and put it into those?
Well, look, I think realistically you have to look at what's happened historically when you've had big IPO or big equity issuance years. And there's a pretty highly negative correlation between equity issuance in a given category, particularly internet, and stock price performance. So to the extent that we do see a really big year from an IPO perspective, that's going to be a headwind that these companies have to fight through. At the same time, these are companies that are taking massive share of the broader economy. I think we all see it in our daily lives of how much more time and money that we're spending on technology. And so I have to think that portfolio managers are going to asset allocate in that direction as well. So it won't just be internet money funding internet IPOs. I think you will see, particularly given how profile some of these potential deals are, I think you'll see money coming out of all areas of the market to fund those issuances.
Heath, you're joining us from California right now. The governor there yesterday, Gavin Newsom, proposed this data dividend that would allow residents in the state to essentially get paid for companies to have access to their data. Now, we're still light on the details, but in terms of the impact this could have on some of these big tech companies, what are your expectations? Is this a real risk investors should be taking into account?
You know, look, I think you have to take sort of all of the regulatory issues around the space into account. The idea of a data dividend is essentially the same thing that we're seeing across Europe. Georgia this morning announced that they were considering a tax on Netflix and streaming entertainment like that. So I think, you know, anytime you have companies that have had the success that these companies have had and that tech in general has had, obviously the government's going to want their share as well. And you know, these companies right now, for better or worse, are sort of easy targets.
Heath, you also like Netflix. How do you game out what's happening in the content business this year, especially as it relates to Disney, and some of the other more traditional players who are going to be putting big emphasis and presumably marketing dollars behind their OTT services?
Yeah, you know, Netflix is sort of the gold standard on this. And I think what we're seeing in survey work that we've done of consumers is they are open to having more than one of these services. I think for consumers that are just going to have one, there's no better dollar content ratio than what you get from Netflix. You look at the amount of money they're spending on content that you get access to for $9, $10 a month, depending upon the plan that you're part of. None of the competitors, whether it's Amazon, Disney, Hulu, are able to offer that same sort of value relationship. Once you've got Netflix, then you might think about yeah, go ahead.
Do you think it might affect their ability to raise prices the way they just did? If there are other competitors out there, might people be less willing to upgrade to a higher level or provide them with that level of extra margin that perhaps they've been getting used to?
Yeah, we're far less I guess, optimistic on price as being a big driver for Netflix. We think most of the growth that you're going to see, the overwhelming majority of the growth that you're going to see, is going to come from subscriber acquisitions. This recent price increase, we think, is probably going to be the last one for a while. I don't think Netflix has any interest in giving a big price umbrella to new competitors like that. Netflix is still priced below most of their cable competitors, and I think that's where they're going to want to stay, at least within the U.S. There are probably more pricing opportunities outside the U.S., but for the time being, we wouldn't expect price to be a big driver of growth there. They're going to get plenty from subscriber additions.